Depot just reported and they're up this morning. Here is what they were expected. Wall Street expected $4.95 per share in profit and revenue of 43.36. This is their press release from the company. They ended up doing $43.8 billion for the second quarter, which was an increase of $2.7 billion, and they made $5.05 per share. Big time growth. Here are the things I like to look at for retail. When it comes to retail, and you'll see this in all the videos we do, I want to look at comparable store sales. Go look at how they define comparable stores, because every company is different, and go see how those stores that have been around for at least 12 months have done in the last year. So here, comparable store sales increased 5.8%. That is strong. And comparable sales in the US was 5.4%. So far, great growth for Home Depot. I like comparable store sales. Of course, inflation, I'm sure, helped that, just like it helped with Walmart. Inflation helps drive revenue. So let's go use our software to analyze Home Depot and use our 8-pillar process. So if you're new to this channel, I'm Paul. I'm a value investor. What I like to do is I like to look at the quantitative aspects of the company, the numbers. I use that as a pre-screening process using our 8 pillars to decide if I need to do more research on the company or not. Once I find the company that I like, I determine the price I want to pay for it. And then once I determine the price, I want to buy it for less than. That's what makes me a value investor. I don't want to pay $1 for $1. I want to pay less than $1 for what I perceive to be worth $1. If this makes sense to you, subscribe to this channel, watch this video, and watch our other 1,700 videos because we release 3 or 4 videos per day. So let's look up Home Depot. And if you have our software, of course, follow along because it's oodles of fun. And it makes, okay, so Home Depot's up $9 today so far, 3%. But as you can see, their high was $420 in the last year, and their low was $267. So it's been, so when I hear people say like, oh, stocks won't fall 30 or 40%, look at Home Depot. This thing's down 40, it has, from peak to trough, was down 40%. So, first pillar, we want the 5-year PE under 22.5. So we go right here to our main page, and it is 26.7. That's an X. Pillar number 2, we want the 5-year return on invested capital greater than 9%. 27.3%, guys. That is huge. That is one of the highest returns on invested. These are like software kind of company returns on invested capital. This is incredible. Pillar number 3, very simple. I just want revenue growth over the last 5 years. That's it. So I scroll up to the top. I go to our income statement and look at 5 years ago. 102 billion, last year 152 billion. That's a 50% increase. Now, one of the things I'll want you to look at, and what I'll do right now, is I'm going to go to our 10K. I'm going to click on annual reports. It takes you right to the SEC website for Home Depot. I'm going to open up the 10K, and I'm going to look at new stores. I'm going to start searching for some things. So we reported, blah, blah, blah. We opened 5 new stores in the US and 2 new stores in Mexico during fiscal 2021. So they are still opening stores, but not a ton. So the question you have to ask yourself is that 50% increase over the last 5 years, how much of it was from new store openings versus just natural growth? And that's one of the deeper dives you need to look at for retail. Pillar number 4, we very simply want profit growth over the last 5 years. So we scroll down to the bottom here. We go to net income. 5 years ago, 9 billion. Last year, 16. Guys, look at how consistent this is. 4.7, 5.5, 6.5, 7.2. I mean, this company just along the way. And of course, it makes sense that Home Depot had a drop in profit during COVID time because this is about 2 months of COVID. Pillar number 5. Now, this one is a silent killer, and I want you to really understand this. Shares outstanding. Nobody looks at this, but it's important to understand if you're being diluted as an owner in the company, okay? So you sit here and look at the company, and they have X number of shares outstanding. When they issue more shares, you keep your share number the same, but you're splitting the profit revenue up amongst more owners. If they're buying back shares, now you're getting a bigger piece of the pie. So we scroll to the bottom to see if they're decreasing their shares outstanding. We go to the end of 6 years ago, 1.2 billion. Last year, 1.03. So they have decreased their shares outstanding. Now, for a company with a 5-year P of 26, I don't like the fact they're buying back shares, but that's something to be analyzed in the future because we don't know if this is actually still a good buy at 26 times 5-year profit. Pillar number 6 is debt. Guys, debt works the same for a company as it works for you. The more debt they have, the more likely they have financial problems and cause problems for the company. So how do I determine if there's little debt or a lot of debt? Well, some 500-foot view, I look at it. I look at the 5-year average free cash flow, $12.25 billion. I multiply that by 5. And that gives me about $62.5 billion, roughly. Is that correct? No, $61 billion. $61.5 billion. We want their long-term liabilities to be under that $61.5 billion. So I go to the balance sheet. I scroll all the way to the bottom. And I look at total long-term liabilities, 47.9. Check mark there. And that's great because it also includes all their leases on their buildings. So I love the fact that their long-term liability is still under that threshold. Now, one thing, before we go to pillars 7 and 8, that's about free cash flow, something that's important. Look at their dividend yield, 2.2%. Now, the average investor out there is going to tell you, oh, great, 2.2. Everybody thinks dividends are safe, but not necessarily. That dividend costs $7.17 billion. You need to compare that dividend to their free cash flow. So right above it, we have the 5-year average of 12.2 and the 1 year of 11.3. So this eats up a big chunk of their free cash flow. I like that number to be under 50%. And currently they eat up over 50% of their 5-year average free cash flow. Does that mean it's at risk? Well, listen, Home Depot is a slow growing company. Part of their way of giving money back to investors would be buying back shares and paying dividends. So I'm not necessarily as worried about that. So back to our pillars. Pillars 7 and 8 have to do with cash flow, free cash flow. So what is free cash flow? It's cash from operations less your capital expenditures. You can do one of 5 things with that. You can buy back shares, pay down debt, reinvest back in yourself, make acquisitions, and pay dividends. I forgot about the pay dividends part. You can do all 5 of those things, any of them, 0 of them, whatever they want to do. But the free cash flow is what's used to grow the business or pay back the owners. So let's scroll down here to see their free cash for the last 5 years. Cash from operations, less the capital expenditures. And your Uncle Paul's so nice. I've added this line to make the math easy for you. 5 years ago, $9.45 billion. Last year, 11.3. Check mark there. Our final metric, our final pillar, we take the 5-year average free cash flow and we multiply it by 22.5, similar to the way we did it for earnings and PE. So we take this $12.25 billion average, we multiply by 22.5. And that equals 240, 245, 24, 260, call it $270 billion, roughly. So we want the market cap to be under $270 billion. So we go back to our metrics page and we scroll here and it's $333 billion. So that's an X there. Now, guys, I've gone through these 8 pillars and it's a lot of math, but guess what? This software does it all for you. Here's the 8 pillars tab. And look at this. Home Depot is a company I kind of like. Why? Because everything's a check except for the valuation metrics. So all we need is fundamentals to get better and or stock price to fall. It's easier for the stock price to fall, as you saw, from going from 420 down to 260. So all these things I like. The question is, where do we want the stock to fall to? So before I get into our stock analyzer tool, which is our number 1 software, you've seen a lot here. You've seen a lot having to do with this software. Well, guys, this software has been a game changer for our community. We made this software because people who were watching our videos requested us when we were using an Excel sheet to evaluate companies, how do I get access to the Excel sheet? So we made it so our users could have it. And it's awesome. It does so much. Here's a list of everything it does. Everything you saw is on a mobile app. It does the 8 pillars. It has 30 years of financial data, has a stock analyzer tool, exclusive daily content. Every single day, the members of our community get exclusive videos just for them. Access to us, real estate calculator coming soon, stock screeners coming soon, retirement calculator. Guys, so this retirement calculator has been a game changer because it allows people to see that, hey, I might have a few $1 million at retirement, but is that enough for me to live the rest of my life? And finally, guys, the biggest thing for our community and for the software is our chat. There are thousands of people in here every single day talking. They all talk about their investment ideas because being a value investor can be a lonely road. And it's very hard to find those people around you to get that. This has thousands and thousands of people in here. You can go in there and talk about anything you want, including crypto and Tesla, even though I'm not a crypto and Tesla fan. But the point is, it's all there for you. This is all available for less than a cup of coffee per day. everythingmoney.com, patreon.com/everythingmoney for international users. If you can make 1 or 2% a year extra or avoid 1 or 2% a year in losses, this will be worth hundreds of thousands, not millions in retirement for you. This is a no-brainer, so sign up. So let's go to the stock analyzer tool. The stock analyzer tool, first thing, we can analyze 1 to 20 years. I usually pick 10 years. It's arbitrary, but I want to look at a 10-year outlook because that's what my outlook is for companies. Now, as you watch this video, please pay attention to how I'm explaining things and rewatch it as many times as you can because it'll really explain a lot for you. So first things first, revenue growth. In the last 10 years, I've done 8% a year. Last 5 years, 10.6% a year. So, and last year was 8%. I want to be conservative. My goal is to be conservative and buy a company with selling for less than my conservative estimates. There are so many companies that do well for 10 years and then slow down. So I'm going to do 3, 5, and 7%. Profit margin. Guys, look at this profit margin. It's pretty consistent between 9 and 10%. So I'm going to go 9, 9.5, and 10%. Free cash flow margin, I'm going to do the exact same thing because it's pretty similar. Now, PE. Guys, the company's currently at a 20 PE. That's kind of rich for a slower growing company, but this company is growing at a pretty decent pace and has a great brand. So I'm going to go 14, 16, and 18. And same with the price of free cash flow, even though the price of free cash flow is currently much higher. But over long periods of time, earnings and free cash flow should be pretty similar. And finally, for my desired return, I'm going to do 12.5%. Why is that? Well, 12.5% beats that ETF of 9 or 10% just by investing in the market. So it gives you a reasonable margin of safety so that you can buy this stock versus putting your money in ETF. I'm going to hit the analyze button. And guys, the stock is currently at 324. You're going to see 6 numbers pop up. 3 low, middle, and high based on earnings and low, middle, and high based on cash flow. If it's all green, don't go out there and just buy the company. Go verify that your assumptions are correct. And if it's all red, that doesn't necessarily mean you shouldn't buy the company. It just means you have to sit there and determine how far away from 324 is it, and should I do my research now to be ready? Add it to your watch list. We have a watch list here. You can pick any of those prices below, add it to your watch list, and you'll be notified on the phone and on email and on our software when that stock hits that price. So, scrolling down. Guys, I'm not surprised based on this PE and price of free cash flow. 160s are low, 275s are high, 210 in the middle. So for me, being a value investor, I'm going to add it at 210 to my watch list. It's going to notify me. If you like what I said here, do me 2 favors. 1, subscribe to our channel. And 2, if you want to learn more about our 8-pillar process and see more examples, please click the next video and you'll learn more about it. Thank you very much for your time.